stop buying breakouts. You aren't unlucky. You're just trading in a vacuum. You are entering exactly where the smart money is planning to reverse. Today, we're fixing your entries. We are moving away from the noise of the live chart to look at the single most important concept for identifying institutional footprints: the fair value gap. Think of the market like a physical store. When price moves too fast, it leaves behind an imbalance, a gap where price was never efficiently traded. Most beginners see a massive green candle and FOMO into the move, but professionals? They see an unfinished bridge. A fair value gap is simple. It's a three-candle pattern. If the high of the first candle and the low of the third candle do not touch, that empty space in the middle is your magnet. Price doesn't just hit these levels by accident. It returns to fill the void before it can continue its real move. Now let's look at the reality. Instead of chasing the price as it leaves the station, we wait for the return. We place our entry inside that gap, specifically at the 50% mark, the consequent encroachment. Now, let's see if you can spot the trap. I'm putting 3 bearish candle patterns on the screen right now. Look closely at the wicks. Only one of these is a valid fair value gap. Which one is it? Is it example A, B, or C? If you chose example B, you're exactly right. Notice how in A and C, the wicks of the first and third candles actually touch. That means the price was efficiently traded, but in example B, there is a clear disruption. That empty space is the footprint of a bank, and that is where we find our entry. But don't just take my word for it. I want you to go to your charts right now. Find the last 3 major moves on the 15-minute time frame and look for the gap that started it all. Tell me in the comments how many of those gaps were filled. I'll be replying to the first 20 of you to help refine your setups. Now, a word of caution. Once you train your eyes to see fair value gaps, you're going to see them everywhere. Your chart might start to look like this. But here is the secret. Just because a gap exists doesn't mean you have to trade it. Think of these gaps like potential zones, not guaranteed reversals. If you try to trade every single one, you'll end up back in that vacuum we talked about. We only look for the gaps that have strength behind them, the massive, aggressive moves that leave the rest of the market behind. Don't get distracted by the noise. Focus on the gaps that are impossible to ignore. Quality always beats frequency. To master this, you need to recognize the 2 faces of the market. First, the bullish fair value gap. This happens during an aggressive move up. Look for 3 candles, candle 1's high and candle 3's low. If there is a clean hole between them, that is your buy zone. This is where big players left orders unfilled and where the market will likely return to find support. Now, flip the script for the bearish fair value gap. This forms during a sharp drop. We are looking at candle 1's low and candle 3's high. When they don't overlap, it creates a ceiling of resistance. In a bearish market, this void is your sell zone. It's the magnet that pulls price back up, only to trap the late buyers before the next leg down. The rules are the same, but the direction is everything. One is a floor, the other is a ceiling. Both are footprints of the exact same institutional activity. Before I let you go, let's do one final test. I'm putting 2 setups on the screen. Look closely at the displacement. One of these is a high probability institutional footprint. The other is just market noise that will likely get you stopped out. Look at the size of the candles and the space between the wicks. Pause the video now and type in the comments, is it example A or example B? I want to see how many of you actually caught the lesson. If you chose example A, you're ready to start spotting these on your own. Notice the violent move away from the zone. That is the scar we are looking for. If you chose B, be careful. The move was too weak and the wicks almost touched, meaning the market is already balanced. Trading those will keep you stuck in the cycle of break-even results. The difference between a trader and a gambler is the ability to walk away from example B. Discipline starts with what you don't trade. Now, your only goal for the next 24 hours is to open your charts and just observe. Don't try to trade them yet. Just find the gaps that jumped off the screen, the ones that actually moved the market. In the next video, I'm going to show you what happens when these gaps fail and how a failed gap actually becomes an inversion FVG. This is where the real institutional traps are set and how you can flip the script on them. Go to the charts, do the homework, and I'll see you in the comments.